Markets see red for the third week in a row, clocking its longest losing streak of 2024. Financials, though, buck the trend to outperform the Nifty banking index, rising nearly 2%. On this week's edition of Editors Roundtable, we'll decode the week on Dalal Street, we'll review the IT earnings and put the spotlight on oil marketing companies. I'm Reema Tendulkar. With me are Nimesh, Prashant and Nigel, and we also have in the house Mahesh Patil, CIO of Aditya Birla Sun Life AMC. Hi boys,
it's
Friday.
Full house today, so all four plus the guest also here. It's like a full house.
No, I think
action-packed week, right?
Action-packed, and I think Friday it really got to a crescendo, right, with the market selling off and then sort of rising sharply. But I think Reema, it's just I think we've gotten to a phase that markets are getting a little tired, right? Because you've run and you've run and you've run, and now because if you think about it, some of the big factors which people started talking about, earnings growth are slowing down. Many have been talking about it for a while. It's just that markets take their own time to get to a level where they're getting it, because there is no problem in global markets, right? Global markets are super strong. Actually, if anything, there is re-acceleration. There is, especially in the US, there is thinking that maybe 50 basis points was a mistake. You don't need 50 basis points. The economy is so strong. So I think, it's just, I think, a little bit of profit taking and that kind of thing.
Yeah. I think markets tiring. I think that verdict we'll hear from Mahesh, but it was a tiring week. I mean, it was a really.
Earnings season chalu hua hai.
But just imagine, Nimesh. Start of earnings season. Normally only Reema's in center stage, right? You only have tech to look at in the initial part. This time you have tech, Sunny Autos, RBI is knocking back. Some of these MBA. You have Nestle, City Gas Distribution. Wow, when you wake up in the morning, you've got the pool of data.
Yes. So Reema starts off the earnings season, Nigel finishes. So IT and metals. Okay, well, that's generally the mode by this time on Friday. Okay, well, let's just quickly wrap up the market action, right? So for the indices, not very much. Nifty down 0.5%. The mid cap and small cap indices, neither here nor there, 0.5% down, 1% higher. But Bank Nifty was a little pronounced, 1.8% Friday to Friday. So that amongst the four indices, Nifty Bank is the one which stood out. Otherwise, sectoral Friday to Friday, autos was a clear-cut loser, full 5% knock for the Nifty Auto Index. And of course, outsized impact because of Bajaj. Metals as an index was down 1.7. FMCG was down 1.6. Pharma was down about 1% as well. And of course, on the other side, you had PSU banks. Not talked about too much, but you look at some of the smaller PSU banks which have reported numbers. Axis Bank, you throw in. So far, so good, right? In the weekend, we'll get more numbers. You look at stocks, I just sort of sorted the big changes. Brokers have had a fantastic week. Motilal is up 30% this week. Angel is up 15%. Names like Century Textile, 13%. Sterling Solar were up 12%. Mastech 11%. 5-Star 10%. These AMCs, right? Aditya Birla AMC. And I don't know, of course, Mahesh has been, I'm sure, taking note, but won't talk about it. But 10% Friday to 11% Friday to Friday. Karur Vysya 10%. On the downside, Manappuram was a big knock, 18%. IGL, MGL, Bajaj 15% knock this week, all told. DMart was down 13%. We kind of forgot about DMart because that is the one, of course, which reported numbers early on. These cable and wire companies, KEI was down about 11%. Bandhan was down 9%, and so on and so forth. So, that's essentially just sort of, the change in stocks and indices that we saw. But I think more than anything else, and Mahesh, I think you'd agree, how the festive season really pans out.
Yeah.
Right? Consumer demand and consumer behavior.
Yeah.
You're tracking that closely, and what are you hearing there?
Yeah, so you're right. I think, there were a lot of expectations that consumer will now, the mantle will shift from the investment-led growth, right, which you saw, right? In the last year or so, it was all investor-led stocks which did well, right? Consumer stocks were kind of lagging behind, and there was a kind of expectation that this year the monsoon is good, rural economy will pick up, and the consumer sentiment is improving. In fact, some of the consumption-related stocks have done well in the if you look at the post-election last 3 months or so. But I think we'll have to wait for the second half, because that's where the festive demand, I think, will come in. I think the initial feedback is that it is, if you look at the commentary from the auto sector, for example, coming in, right? It's not that great, no? What expectations were there? We were expecting a growth of around, say, high single digits or so. It looks to be in the mid single digits or so, right? So clearly it's not as good, but it's still mixed, I would say. I mean, in the consumer durable side, okay, they are hoping it to be better in this festive season. So I would say that still finger crossed over there, but I think that is important for the market sentiment to improve, because I think that's, if consumption starts to do well, I think then we are in a much stable wicket, okay, for the earnings to do well, and even for the overall growth to sustain from a longer period perspective.
Mahesh, you've analyzed the market moves, and your key takeaway or analysis throws up that the market breadth has deteriorated. So take us through, what your data tells us.
Sure. Plus, if you look at until say the election outcome, right? Because that was a turning point, I would say. Until then, if you look at the market breadth was very good. When I say market breadth, means the number of stocks which are beating the benchmark, right? I mean, that ratio was at an all-time high. If you look at how many stocks are beating the BSE 500 within BSE 500 by 10%, that number had gone to around 40% also, right? So that number is now coming down. In fact, if you look at the peak of the election day peak, since then the market is up, but there are more than 30% of the company stocks which are actually now below that, negative territory. So clearly, I think the breadth is weakening. And now what we're seeing is that, I mean, the earnings momentum itself, which was there, which was again driving, one was earnings momentum and liquidity also, right? So while liquidity, domestic flows are strong, we've seen the FIIs, especially in the last, I mean, this month till date, I mean, I was seeing the number, it's almost $8 billion of sales which have been there. Yeah, almost 70,000 crores. So that has been hurting, and I think we've seen the pain slightly. There's some kind of a profit taking which is happening in the broader market, and there's some distribution pattern what we are seeing, and that's where I think you have to be slightly careful. And for the first time, we are seeing companies actually reacting to negative news, right? Yeah. I mean, the last 2 quarters. I mean, earlier it didn't really matter. Yeah. So it's becoming more discerning, I would say, the market.
How much cash is there? I mean, do you because Nimesh, you look at that number at the end of the month. I think there was.
So on an average, 5% is the average cash levels for AMCs, and that would work to close to 1.2 lakh crores, 1.3 lakh crores of the total AUM, which would be in cash. I mean, just
all this money, all this selling from FIs has been absorbed.
It's largely been absorbed, right?
I mean, IPO
exactly. That was 25,000 crores of IPO.
So is there a lot?
So I think cash would still be there, because see, there is a lot of passive cash which is there. Right? Also, the market's correct.
Yeah.
There are these hybrid funds, right?
Yeah.
So they can come in, but for the market has to correct significantly. We have seen the Nifty has been there, but the breadth is weakening. So that's where the challenge is, I would say.
What's the cash that you all are sitting on?
So we're not sitting on much cash actually. So we are actually playing, because it's very difficult to take a market call, right? Yeah. People would have done that around 6 months back also, and they would have actually. So it's more to play within your portfolio, right? Trying to go more defensive, not chasing beta. So I mean, that's more stock selection rather than taking a large cash call. But clearly we are more cautious.
Nimesh, the cover.
So just to give you a bit of a basically with the feel of the market or the mood of the market, as even Manish pointed out. 70,000 crores of selling for the FIs. It's largely been matched by the DI buying, because they're sitting on so much of cash that's getting deployed. But again, bad news is getting sold very heavily. We saw 2 accidents this week, right? Bajaj Auto numbers were good. Just a small commentary that the festive season demand is not good, and we saw massive correction in the auto stocks on Thursday and Friday. Today we saw massive correction in the oil and city gas companies, right? So that shows the kind of momentum which is there in the market. As you rightly pointed out, Prashant, it looks like the market is tired. The simple reason is because for the last couple of months, at least the traders are not making money. And now at the margin, even at the portfolio level, you're seeing a bit of downtake as well for individual investors. That's why the momentum has broken very clearly. It started with the PSUs, because that's been the biggest overweight for retail. And you've seen a bit of correction there. And hence you're seeing a bit of loss of momentum in the overall markets as well. CLSA put out a nice note today, the technical analysts, and they are now believing that the next level to watch on the downside would be 200 DMA, which is almost at 23,000 on the Nifty, right?
So not a very nice note.
Not a very nice note.
That's the peak which the market reached during the election high.
Election high.
That's the same number.
That's the reason why it's very important.
The June level.
June level of 23,000. So again, that's the level to watch on the downside. Having said all this, for next week, we have the Hyundai listing. Now, suddenly there is no premium, right? It's at a discount now. So need to see how it lists. And there's another large IPO which is going to come up, which is Afcon's Infra, part of the Shapoorji Group. I understand already there is a demand of almost 11x in the QIB book. So again, that's going to be a very important IPO to track. So IPO is sucking a bit of liquidity. There is aggressive selling from the FIs. Need to see how the momentum seems to be, because in general, even in the broader markets, the retails have lost a bit of momentum. And that's why you're not seeing a bit of reaction in the market now.
There's also Vari Energies, which
Vari
opens up
Energies.
for a subscription, and it's reasonably sized, close to about 4,000 crore rupees. But I just want to quickly recap all the IT earnings that have come through this week, and we had all the big ones. Whether it started off with HCL Tech, and then we had Infosys, Wipro, LTI, Mindtree, and throw in mid-cap names like Mphasis as well. So here are some of the key takeaways. Now, broadly at the headline level, the numbers were fine. Q2 has played out in line with street expectations. So on the top line, you would see that most of the companies delivered, like Infosys delivered versus expectations, TCS delivered, HCL Tech and Wipro were a beat. The margin performance was mixed this time vis-a-vis expectations. So on one hand, you had a TCS and Infosys missing the mark, but again, Wipro and HCL Tech's margin performance was higher than consensus expectation. There are two key trends which have emerged. One is continued momentum in BFSI. It started in Q1 and it's played out in Q2, and the management commentary seems to suggest that it's more broad-based this time. Some of them are talking about discretionary spending picking up in the BFSI segment, and almost all of them are confident that the BFSI momentum will sustain going into Q3, and this is about 30-35% of the industry revenue. And the second trend is there is a pickup in hiring. Remember, the IT companies went through a long period of headcount rationalization, almost 1.5 years, and now finally you are seeing some hiring pickup. It's seen as an indicator, a forward indicator of demand picking up. But what's the way forward now? Now, come Q3, the outlook is a little bit more muted, largely on account of furloughs and lower working days. So you have a Wipro, which gives you a quarterly guidance, and they're talking about a -2 to a 0% growth in December quarter. Now, Infy's full year guidance, which got upgraded this time, still bakes in about a flat growth in Q3 and Q4 if they have to achieve the middle end of the guidance. Also in the coming quarter, in Q3, you'll have the wage hikes. So companies like HCL Tech, Infosys, LTI, Mindtree, Wipro also will have a 2-month wage hike impact. So that will hurt margins for the companies going ahead. Now, keep that in context with the kind of up move the stocks have seen. So on an average, companies are up between 20 to 40%. Names like Infosys, which corrected sharply post numbers, though that stock was up nearly 40% since the rally began in June. And this is how the valuations stack up. Infy so it's TCS still right on top of the pack. Infosys retreated a bit after the correction. HCL Tech and TCS's valuations are pretty much at par right now, and it's Wipro which is lagging behind. So Wipro's valuations are at a discount, and that's one of the reasons why we've seen the Wipro stock price do well post the numbers came in line with street expectations or marginally better. So Mahesh, where do you stand on IT? Have you been playing the IT rally over the last 4 months? Do you think it has legs to continue?
So IT, again, it's kind of a one for us, is like a contra sector, right? I mean, where you want to go counter-cyclical, right? I mean, IT negativity started much earlier, right? It's been underperforming, and a lot of the negatives are known over there, right? So while it is not exactly cheap, but we think that the downside there is limited. So it becomes a kind of a defensive play in that sense, because anyways, we don't expect any major strong growth, okay, in the market. And if you look at the commentary of the IT numbers, okay, which have come in, right, nothing great. I mean, we're not seeing any meaningful upturn, but I think it is broadly, I think in line. So, so I think this is a sector where we were underweight. We've increased the weight a bit, but still a kind of a neutral-ish on this sector at this point in time.
And how would you play IT? Would you go with the large cap blue chip names like TCS, Infy? Would you go with a Wipro where there is valuation comfort, or even in names like Tech Mahindra? Would you prefer BFSI-related players like an Mphasis, or those auto ER&D companies like KPIT?
Yeah. So I think large caps, I think we are seeing some kind of a pricing pressure now. So that's where I think these smaller and the mid-sized company could come under pressure. They have done well up till now, if you look at it. So we'll prefer the larger cap plays. Within that, I think the discretionary plays which got hurt, right? Some of the names, right? I think there you will see the first turnaround, and especially in the more focus on the BFSI sector, where you're seeing things kind of started to go down much earlier, and things are
so like Infosys, LTI, Mindtree, etc. These. All right, let's move on and talk about another theme. Now, oil marketing companies were in focus because we've seen a big fall in crude prices. So the question is, will the street look through the Q2 inventory loss and bet on a solid Q3? Nigel, what are the numbers telling you?
Well, Mahesh, I want your view on these OMCs. I'll just put out the piece and we get your view out there. So for the last week, in fact, there were a couple of triggers that played out in favor of the OMCs. One is that there was no escalation of the global tensions, the geopolitical tensions. And that's where we saw that crude oil prices did cool off, because Israel says that they are unlikely, or the indications are they're unlikely to hit Iran's oil infra, which is good news. And that's why you saw crude oil prices that soften. The other point was everyone was worried whether or not we'll see a petrol price cut. Now we have the code of conduct that's kicked in for the states that are going to elections. So that's unlikely to be the case. So that's good news as well, both on the input side as well as on the selling price side. Now, moving to the inventory loss. For the coming quarter, there's going to be a hit. So you brace yourselves for that. And that's the broad estimates that have come in, that there is going to be an inventory loss because crude oil prices did correct substantially in the second quarter. The question is, will the street look through these inventory losses in the second quarter and brace for a solid showing in quarter three? Why do I say that? Because the refining GRMs, they have been under pressure, but that's a well-known thing. The important part is the marketing margins have now started moving up. And marketing margins in the last few quarters, well, they've been in that vicinity of around 3 to around 6 rupees odd. As of latest count, it's close to around 10 rupees. And the marketing margins have improved drastically, which could brace these companies for a very, very good showing in the third quarter itself. And when you're looking at, the companies, all the three OMCs, you look at the marketing volumes in comparison to the refining volumes. And by that stretch, HPCL appears best placed because the amount of marketing volumes are much higher. And that's for BPCL as well as IOC. So that's another trigger to track with regard to the marketing volumes being much more than the refining volumes, because we know the refining GRMs have been a little bit subdued. Now, valuation-wise, well, these companies are trading in those mid-single digits, close to around 6 to around 8 times odd. And they give good amount of dividend yield as well. Among the three players, HPCL could be better placed because they have that demerge of the lubricants business that could take place, which will unlock value out there. And also, as I mentioned earlier, the marketing volumes are higher than the refining volume. So the question is, OMCs look set for a solid quarter three. Will the street look through the quarter two inventory loss and then brace for a bit of a re-rating? Well, that's going to be the focal area. Mahesh, I wanted your view. Not, a space for the faint-hearted, but just last week or close to around 2 weeks or so ago, everyone was wondering whether or not crude oil prices are going to scale up towards that, $85, $90 per barrel mark. And also whether or not we'll see a price cut.
Yes.
Both didn't come through, which is good news for the marketing margins. Will you want to play this theme?
Yeah, I mean, again, here there are too many variables, right? You don't know what the government is going to do, how the crude prices are going to stay.
For sure.
Yes, right. And while the numbers, as you said, will be weak because of the inventory loss and refining margins, but again, their valuation comfort is there, right? So which gives the support. And by and large, I think we have seen that the government has allowed them to really look at a composite margins, right? You're refining plus marketing margins and see what you want. And that's how the market has started looking at it and overlooking the short-term gyrations in terms of the marketing margins. So I think given that and the fact that the stocks haven't really done much, I think, they could be reasonable plays over here because I think market would not be too worried about the short-term kind of a loss if they report, right, on the inventory side. So, so they look fairly priced. I think, again, we don't see any big growth. It's not a growth sector.
But it could be a tactical play in the near term.
Could be, yes.
What about, since we're on the subject of oil and gas, City Gas, was the fall a little excessive for these stocks today?
Yeah, I would guess so, yeah. I mean, again, these stocks had also done well. Okay, if you look at it in the last 6 months, right? Okay, these stocks had again kind of rallied again. So again, I think it's more to do with the overreaction because of the sharp rise what we have seen in the last 6 months. Obviously, there will be some impact, but I think the reaction seems to be more excessive, and that's what's happening in the market currently, right? I mean, sectors which have rallied, okay, they are reacting, doing some kind of a mean reversion and also reacting to that negative news. I think it's getting amplified in that sense.
Mahesh, just need to get into a very short mandatory break. We'll come back and continue this fun discussion on the market. Stay tuned.